equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I am pumped for this episode. A lot of what we talk about here on Equity Mates are some of the big megatrends that will define our lives and create great investing opportunities. And there's probably no bigger megatrend and no bigger tailwind than the changing demographics of this world.
Yes.
And the fund manager that we've got on the show to talk to us today is investing on the basis of demographics.
That's it. We've got an expert here to help us unpack it all. It's our pleasure to welcome Alex Gold to the studio. Alex, welcome.
Good evening to you guys. Good morning from here. It's good to be with you.
So Alex is a portfolio manager of the Fidelity Global Demographics Fund, and it's available on the ASX. The stock ticker is FDEM. And we're really going to be unpacking what the fund does, some examples of the big tailwinds that Alec was talking about, and then have a chat at the end about some of the top holdings in the company and how it relates to the demographics thematic. So we appreciate the support from Fidelity. This episode is sponsored by Fidelity. So let's get stuck in, Ren. A bit of an intro to the fund.
Alex, demographics. What does this mean, and why do demographics create a good investable opportunity?
Yeah, so you touched upon a good point earlier when you talked about the importance of megatrends, which I think a lot of people are aware of from a top-down perspective. But when we think about demographics, it's really about taking a long-term view behind several of these megatrends, which are structural drivers in the world, and investing behind them. And so we've identified three key megatrends, which we think are particularly important over the next couple of decades, really, even longer. The first of which is what we classify as longer lives. So this is the aging of the population as people get older. And there are some great stats about the proportion of the population that will be over the age of 65 in 2050 versus now, for example. And we can dive further into that later if that's useful. The second area is better lives, which is really just the expansion of the middle class. You guys in Australia will know that, more than us, I would have thought, with the, your proximity to China and the fact that, there's this huge bolus of Chinese cities and citizens who are getting wealthier by the day and, really going through that kind of industrialization and consumerism process that we've been through over the last 100 years already. So that's a great opportunity. And then the final one is really more lives, so population growth. And, the world is continuing to grow from the current levels, and we've got good predictability in terms of birth rates, where that will be in the next couple of years, in the next couple of decades even. And that creates opportunities as the population grows, but also challenges, from sustainability perspective and resource perspective. So, those are really the key things that we're looking at. Longer lives, more lives, and better lives is how we define it.
So then, Alex, of all of the possible demographic trends that you could sit down and try and make investment case for, why are those three, aging population, growth of the middle class, and overall population growth, why are those the ones that you've chosen, and what makes them investable?
It's a good question. So we think they're just so pervasive. They're in everything. So, obviously other mega trends like, water or waste or sustainability are also very important, but they're completely interlinked to those trends which we've identified. So population growth puts pressure on resources, means it's more important to conserve water, to manage waste, accordingly, and from a sustainability perspective, make better use of resources. The aging of the population is completely interlinked to healthcare, and the fact that our healthcare needs are increasing, and we need innovation around that, and there's lots of exciting verticals within that. And then there's also a further one, which is the fact that the dependency ratio from an aging population means that you have less people working than those who are retired over time. And that's the trend which we're going on, which increases the importance of technology and automation. So we think these are three of the big, structural megatrends. And then there are lots of verticals within those.
So Alex, more lives, better lives, longer lives. It paints a pretty good picture for our future. What are the numbers telling us? What does if these demographic trends hold and we project forward, a decade, multiple decades, what does the world look like and what do our lives look like in the years to come?
There's some great stats around this, which most people are probably familiar with, but still, surprising when you sort of, look out 20, 30 years. So in terms of the aging of the population, there's in 2015, for example, there were 900 million people globally over the age of 60. By 2030, we'll have 1.4 billion people over the age of 60. Wow. And by 2050, we'll have 2 billion. So we're going to go from 900 million in 2015 to 2 billion people over the age of 60 by 2050. So you can just imagine what that means in terms of healthcare needs, spending habits, a huge variety of things. The second area, which we spoke about, better lives, the rise of the middle class, various definitions in terms of pay to define middle class. But we're going to go from 3 billion people globally being in the middle class in 2015, which is about 50% of the global population, to 8.5 billion people will be defined as middle class. So 5 billion of the 8.5. So 5 billion people will be middle class by 2030. So we're going to go from 3 billion to 5 billion. Again, that's, a huge increase in people's spending and purchasing power. And in terms of population growth, we're going to go from 7 billion, or so currently to, 9.7 billion by 2050. And these aren't kind of, trying to forecast Tesla's production numbers next quarter or next year. These are like fairly well understood, World Health Organization or whatever numbers. They're pretty indisputable. When you look at it from that lens and then you think, what are the opportunities within those? We think it's really powerful.
So then if demographics, one, will likely be the biggest drivers of earnings growth in years to come, and two, are highly predictable, why isn't this opportunity already priced into, I guess, the investment opportunities?
Boils down to a lot of, what investing is in its very essence. So, for me, the critical reason why it's not priced in is duration. I think when people think about investing and putting a portfolio together, there are various approaches and investment philosophies in terms of how you can do it. But one approach is to obviously buy an ETF, which allocates capital on the basis of the market capitalization, the size of a company, but takes no view on the underlying quality or cyclicality or long-term demand of those businesses. The other way is obviously active investing, which is what we're focused on at Fidelity. And here, what I do is you construct a portfolio of companies which we think are good quality, operating good end markets, have good management, allocate capital well in terms of how they spend it, whether it's on M&A or new capital equipment to build their businesses. And we think that by doing fund management actively and by deciding where we're going to invest our capital, we can identify companies where the duration of the earnings growth and the revenue growth and the opportunity is often underestimated by the market. And so that, as you said, they're well identified, the drivers, but, often if you take a longer term view, you will see through some of the shorter term fluctuations in the market, which we think is an opportunity.
When we were sort of talking about this fund here at the office at Equity Mates, one thing that really struck us was that while the demographic changes may be predictable, and you spoke about some of the numbers before, that doesn't necessarily mean that the companies that are going to win as a result of these demographic changes are highly predictable. So what characteristics are you looking for in companies that will become eventual winners in markets and really be the ones that ride these demographic trends, especially when maybe these markets aren't even fully developed yet?
You're certainly right. It's not predictable finding the companies that will be leveraged to this trend. So, so obviously we're fortunate in terms of our resources with 240 analysts globally, over I think 16,000 company meetings when we sort of meet the CEOs and CFOs of all these companies in the last year. And so we have a great resource to try and understand which companies may be the winners. The key characteristics that we look for in the fund is to identify companies which operate in attractive end markets within these mega trends. Some end markets cyclical. Some of the markets are kind of structurally growing much faster than others. We like companies with pricing power, particularly at this point, with inflation being a concern. But pricing power is always important because what it means is a company that has an ability to put up prices year after year clearly has some form of competitive advantage or a moat, as Warren Buffett and people would term it, which means that it's structurally a good business. So we look for good businesses with pricing power, oligopolistic or well-structured end markets. As importantly, we look at who is operating those businesses. What is the management team like in terms of their track record? What are their priorities and how do they allocate capital? That's really important. How do they spend as an owner of the share, you own part of that company. That's how we look at it. You're not just trading it, you own part of that business. So how do the people running that business manage the cash and what do they do with it?
So Alex, one of the big opportunities in demographic change is in emerging markets. However, 70% of the fund is sitting in US, French and Japanese equities. So how do you think about or can explain the geographic distribution of the fund?
So you're right. A lot of the companies we own are in those developed areas. And the reason for that is because a lot of them are very well established in terms of, their businesses and their brands and the products they have. But a lot of their sales will be in the emerging markets like China. So the figures you've quoted are where the companies are domiciled, where they're listed on the stock market. But if we look at their revenue exposure, for example, 32% of the revenue exposure of the companies we own is in emerging markets. And the US is, 50, as you said, over 50% is domiciled in the US, but actually only 37% of the revenues are in the US. And then there are lots of examples, but whether it's companies like LVMH, where 35% of their sales are in China, or whether it's Nike, where, again, about 35% of Nike's sales are in China. A lot of the companies we own are very geared or driven in terms of their growth rates by emerging markets.
I think that's a really important thing to stress for a lot of beginner investors, that where a company's revenue comes from will matter a lot more than where it's listed. In Australia, we're pretty inward looking. We export some minerals, but we don't do a lot outside of that. In the UK, obviously, revenue comes from a lot more diverse sources, but it's a good reminder that just looking at where these companies are listed doesn't tell the whole story. But Alex, would love to get a little bit more specific and talk about some of these demographic trends, and I guess really unpack what the trend is, what the numbers are telling us, and then where the investment opportunities are emerging from this trend. So maybe if you pick one, and we'll start there, and then maybe we'll go on to a second. Yeah, if you talk us through sort of that top-down process that you go through of identifying the trend, figuring out what the trend is telling us about the world and what the world will look like, but then actually figuring out where the investment opportunities will lie at the end of that.
Sure. So, so a good example is of a trend within a mega trend is healthcare. So when we talk about the aging of the population, which we touched upon at the beginning, what that means, as we have, huge proportion of the population globally turning over 60, is that means that there is an increased healthcare need. And so there are two ways to kind of think about this. One is, okay, healthcare spending is going to increase, but the other is, how can healthcare systems sustainably manage this huge, increase in demand? And so the various statistics, from in the US, we've got, they already spend 17-18% of their GDP on healthcare. China spends 3 to 5%, so very low. And the average in sort of the OECD is, 8-9%. But the US already, the US is the primary area which spends 17-18%. And so as the US, which also has the baby boomers and has a huge increase in their over 60s, increases in terms of their healthcare need, what that means is healthcare spending will continue to increase, but it can't continue indefinitely when it's at that level. So what you need is companies with innovative products that do two things. One is to improve the health outcomes of their patients. That's obviously rule number one. And there are great companies in Australia like CSL, for example, that is a world-class company globally that has some products that help their patients. But the other key area, aside from helping patient outcomes, is to do it in a way that saves the healthcare system money. So this can be things like minimally invasive surgery or vertically integrated healthcare systems or diabetes patches or robotic surgery, all of which aim to basically reduce complications, keep people out of hospital, which is very expensive by the time you get there, and then save money to the healthcare system. So the companies that develop products that are able to both help patients get a better outcome, but also use innovation to help do it in a more cost-effective, timely, efficient manner is really where the opportunity is.
So if healthcare is one example of a demographic trend, is there another that you would be able to share?
Yeah, so another really interesting one is automation, and this is linked to the facts, of population growth and the fact that we have an aging population. And as I touched upon earlier, what that means is we've got a dependency ratio which is rising. So this is the proportion of non-workers, so people that have retired, to the working population. And we've already seen this in Japan, which has already gone through this kind of demographic structural shift, a few decades before other areas. And what it means is over the last 20 to 30 years, not just in Japan, but many areas of the world, we've seen lower productivity in terms of people's output. And how do we counteract that? And that's only going to get worse as the population grows and as people get older. So the best way to counteract that is automation. And so in Japan, for example, there are a number of world-class companies that do factory automation, which is about ensuring that when you do manufacturing, you use robots that basically help do it more efficiently. And it's not the sort of stuff of science fiction has kind of been around for like decades, but as it evolves and it becomes better and better, you can augment the kind of the high value work that humans can do with machines that can help automate some of the more manufactured processes. And so there are lots of companies, whether it's companies focused on manufacturing per se, or whether it's focused on agricultural productivity to try and improve and enhance yields and use data analytics in those sort of areas. Automation is a really important area of focus to, again, offset some of these, top-down thematics, which are definitely going to happen.
Yeah, I imagine when you're thinking about the aging demographic trend, looking at Japan is just a real look through to the future. Some of the stats out of there are just mind blowing. The one that always gets me is it was probably years ago now, but more adult diapers were sold in Japan than children's diapers, which I guess
heard that one.
Yeah, which I guess is probably going to happen in a lot of the Western world in the coming decades.
Well, isn't China now really encouraging their population to start having more and more kids because they're aging too quickly?
Yeah,
exactly. Yeah.
But on the other hand, like 60% of India is like under 30 or something.
Yeah.
It's crazy.
Well, if we see that Alex just goes incredibly long on adult diaper manufacturers, we'll know we've done something to help.
So, Alex, before we have a chat about some of the specific companies in your top holdings, we're just going to take a quick break to hear from our sponsors. So, let's get specific. The Equity Mates community love talking specific stocks, and we've had a look at the fund's top holdings, and we're really surprised to find that the four biggest holdings are Microsoft, Amazon, Apple, and Alphabet. So what is the demographic driver for these sort of four big tech companies?
It's important to address it because you're right. You probably wouldn't think, I'm buying a demographic fund, that's what I'm going to own. And it's something that we think about a lot, internally. And, when we're, as part of our investment process, when we're allocating capital and deciding which companies to own, we have to have a demographic rationale for every business. And we have to identify which of those thematics that we've talked about earlier they are aligned to. And if we can't do that, we can't own it. And there have been examples where we haven't owned companies on that basis. So I'll quickly run through them. So Microsoft, the key driver actually of that business is their hyperscale cloud business. And what's interesting is, that's the number we had a meeting with them 2 days ago, but the numbers are mind-blowing because they've just reported, but it's a $44 billion business from nothing 5 years ago the cloud business I'm talking about, is growing at 40% per annum. It's going to be $100 billion as people transition their workloads from on-premise into the cloud. And what that means is Microsoft is growing to high teens, even though it's absolutely huge business. And so why is the cloud demographic? Well, Jeff Bezos in his letter for Amazon, because Amazon is the biggest player in hyperscale cloud, highlighted that actually not only do you have 30% greater efficiency in terms of by being on the cloud for your business, but most importantly, it's 90% less energy intensive because you have these huge hyperscale cloud infrastructures, which is what Microsoft and Amazon own, rather than a little data center in every corporate company around London or New York or whatever. And so really that energy efficiency of being in a much bigger infrastructure is why we think Microsoft is aligned to demographics. So that's the key reason for Microsoft. And it's the same for Amazon. Everyone thinks of Amazon as the platform where, well, especially during COVID, where you bought everything from. But actually the retail business is very low margin, 0 to 2% margin. And actually Amazon's entire profit effectively is driven by AWS, which is Amazon Web Services. That's 55% of their earnings. That's the 30% margin business. And that is the key for Amazon, is this hyperscale cloud business, which again is about better using resources, more energy efficient, which is, given population growth, et cetera, is very important. So those are the reasons for Microsoft and Amazon. Apple, when we look at it, a third of group sales are in China and Asia Pacific. So, as people, that really is two things. That's about population growth in the emerging markets, but also it's about the middle class spending. I wouldn't say it's aspirational because China has lots of, very good businesses that sell mobile phones as well. But the iPhone is something that, it grew 70%. iPhone sales grew 70% in China last year to, $69 billion. So it's not just the US and Europe that buys a lot of iPhones. And then finally, Google. Google's an interesting one because a stat that struck me when I spoke to our analysts, a couple of weeks ago on this is that it's an advertising platform, search platform, which we know, but 70%, so 70% of Google's revenues are actually from small businesses. And so when we think about what does that mean, our analysts kind of like to use an analogy, which I think is quite powerful, is that effectively digital advertising is the new rent. Lots of companies are digital only now. They're not going into bricks and mortar. They're just having an online presence and they're advertising and reaching a hugely expanded audience through digital advertising on Google. And that kind of 70% of small businesses is like an enabler of, of reach and again, efficiency really, because you're not having to buy a brick and mortar shop, you do it online. So that's the rationale for those big four. Not all of their businesses are 100% demographics, but large portions are. And then, in the rest of the fund, we analysts say exactly which proportion is demographically driven and which isn't.
These companies are just global giants, and as global population grows and gets wealthier, and the middle class expands, and I guess people live longer and consume longer, they're gonna just have bigger populations to sell to. One question that's just come to mind, we talk in general strokes globally about our lives getting longer, better, and there being more of us. Is there anywhere where you see, is there any parts of the world where those demographic trends aren't holding, where they're really bucking the trend and lives are getting shorter, or the middle class is shrinking, or populations are just shrinking generally?
I think in certain parts of Europe, we've certainly got the population's relatively stagnant. You still have the aging of that population. But I think the beauty of the fact that we look globally is that some areas have lower growth, but France, for example, Europe, for example, has no population growth, but it has the aging population element, which, almost by definition, if you're static and your population ages, you're one of the mega trends is going to impact you. So the areas of fastest growing population growth are in Africa, where there are fewer investment opportunities directly in that region. Each of the other themes we've talked about, to be honest, are pretty pervasive, throughout the world.
The whole Africa opportunity could be a whole other podcast because it is just fascinating world out there, and there's some interesting companies. But let's focus on the companies that you are investing in. Outside of the 4 big tech companies that we touched on before, would love to, I guess, unpack maybe 1 or 2 companies that you're particularly excited about in your fund. And for each of the companies, would love to unpack what it does and what's the investment thesis, how does it tie to a demographic trend, and then, a little bit about what you think the future looks like as these demographic trends play out.
Sure. So I guess there are 2 companies which I think there are lots, but 2 which are quite interesting. So the first, which I'll talk about, is LVMH. So LVMH, is the sort of luxury goods company that has a huge amount of, high quality brands and assets ranging from champagne and wine, perfume, fashion, leather, watches and jewelry, with the likes of Louis Vuitton, Christian Dior, Fendi, and they recently bought Tiffany, diamonds as well. What we like about that is, clearly that is a play on emerging, middle class and spending. It's quite fascinating. They again had results recently, and their sales were up 36% versus 2020. They were up 14% versus over 2 years versus 2019. So we've had a pandemic. Everyone thinks of recession, and the last thing you're going to do is go and buy a handbag. But actually, their sales are 14% higher now than they were in 2019. And the reason for that is because, I guess, we had stimulus checks in the US. So some people would have spent their stimulus checks not just trading on Reddit, but also, buying products. But also in China, there's a really interesting element. So, 35% of sales are sort of Asia ex Japan. And a statistic which the company spoke about recently is that in China, once you get to $30,000 of annual income, you will spend the same amount on luxury goods as in the UK or America or Australia when you earn $100,000. So the propensity to spend as a proportion of your disposable income is so much higher in somewhere like China than other parts of the developed world, which is fascinating.
That is fascinating. Is that because cost of living is a lot lower as well, or is it just different spending habits? Yeah.
No, well, yeah, I think part of it must be cost of living. They probably pay a much lower rent, for example. So part of it will be spending being lower. But I think also, I read history at university actually, and I think a lot of it will be conspicuous consumption. This is something which we went through, 200 years ago in the UK, where people wanted to spend money to show that they had reached a certain wealth status. And I think China is going through that journey now and is quite far through it in many respects. And so, spending your money on conspicuous consumption and luxury goods is something which is a higher priority perhaps than other areas of the world.
China is, well, it's, we spoke about its demographic challenges, but it's, the story of its middle class is just phenomenal. Well, it's like 600 million people they've brought out of poverty in the last decade or something like that. And I assume you expect a lot of Southeast Asia to just massively increase their middle class and their purchasing power in the coming decades. When you project forward a decade or two, like what do you think LVMH and, all their luxury brands, like what does the business look like?
Yeah, so, the growth rates which we've seen over the last couple of years, the 14% over 2 years, it's still below what they've historically achieved. And, when we look forward, we quite easily get to, high single digits of 9 to 12%, top line growth. And then a lot of these businesses then have, a bit of margin expansion opportunity. And then, importantly, they then are continuing to build out their brand of brands. They bought Tiffany for, I think, $14 billion or so, which was 1 year's cash flow. So, next year when they earn another $14 billion, they can buy another. They're not going to buy another Tiffany, but, they have the ability to keep spending to build out this portfolio of world-class brands, which, that creates a moat. China or even in Europe or the US, you can't just, build a portfolio of assets like that overnight. That's, a defensible moat, which, gives them pricing power and a continued opportunity to take advantage of that growth opportunity.
14 billion free cash flow. That's pretty nice.
Yeah.
All right, so Alex, we've probably got time for one more stock that is particularly interesting you outside of those, the four big tech. So again, sort of what does the company do and the investment thesis behind it? And then how does the future look for this company when you're thinking about the demographic trend?
Sure. So another one is one that people may have heard less about, called Thermo Fisher Scientific in the US. And so Thermo Fisher is a leading world-class healthcare company. And obviously this plays into the aging population and increased healthcare need thematic. And so what they do is they are vertically integrated in the fact that they sell research equipment, analytical machines and equipment to researchers at biopharma, pharmaceutical and biotech companies to conduct their research. And they sell all the consumables to let the scientists and researchers do their research. That's called life sciences and analytics. And then they also will help manufacture drugs for their biotech and pharmaceutical clients, because actually a large part of drug manufacturing is outsourced, and the very large pharma companies do some in-house, but they also outsource. But some of these very small biotech companies, where there's been a lot of funding into biotech in the last 5 years, they develop their own drug, but they do not manufacture it. They outsource it to a company like Thermo Fisher. And then the other area that they do is they help run the clinical trials for biotech and pharma companies. So they're kind of the infrastructure behind a lot of, drug development. And so what's interesting about it, I think, is that rather than taking a binary bet on whether an Alzheimer's drug or an oncology drug is going to work, these guys are exposed to all different modalities and therapeutic areas. And the analogy, which I think is apt, is, in a gold rush, you want to actually own the picks and shovels manufacturers, not the gold mine. You don't want to look for the gold mine. You want the picks and shovels who sell to everyone. And this is what these guys do. And, it's a business that had a very resilient and successful period in the last 2 years during COVID, because they also do diagnostics. And so all the diagnostic testing, all the COVID tests, which we've all had, the PCR tests, they help sell those and the equipment to run those tests on. And so they actually, in 2021, they earned about $8 billion in revenues from, helping do those COVID tests, which again, if we think about healthcare, diagnostics and COVID testing is really important, because that stops people getting ill and getting to hospitals if you identify it sooner, and stops it being spread. So it's a really powerful thing. And so when we look at the longer term prospects for Thermo Fisher in terms of, those areas in which they operate, they had a capital markets day last year where, they articulated that they hope to grow their top line, their sales, by 7 to 9% per annum. They want to do 50 to 75 basis points, so it's half a percentage point of margin expansion. And then they, generate a lot of free cash flow, not as much as LVMH, but $7 to $8 billion a year. And their strategy, because it's a very fragmented end market, each of those markets in which they operate, there are no big competitors. It's, consolidating lots of smaller ones. Their strategy is to use that free cash flow for M&A and to continue to build out the suite of services they can offer their pharmaceutical and biotech clients. And it's been very successful. If we look back over the last decade, they've, grown their top line by 7 to 8% per annum. They've grown their free cash flow by 19% per annum over the last decade, partly aided by the COVID tailwind of testing, but in the last few years. But going forward, we see a picture of them achieving that 7 to 9% top line growth and 14 to 15% earnings growth, which we think is very attractive.
Yeah, it's not a company I've heard of, but I just had a look, $240 billion market cap, 10 bagged in the last 10 years.
Wow.
It's the thing I love about investing. There's always another company that you haven't heard of.
There's always a 10-bagger.
There's always another one out there. So two fascinating companies, and I'm sure there's plenty more. If people want to have a look at some of the other companies in the fund, they can jump on the Fidelity website, look at the Global Demographics Fund. The top holdings are there. Alex, we have almost reached the end of our time. We do like to finish with the same final three questions. But before we do, as well as the Fidelity website, if people want to learn more about yourself and the fund, and also maybe more generally about these demographic trends and how they can invest in them, is there anywhere in particular they should be going?
Well, I think there are quite a lot of books written about the key trends, but to be honest, they'll probably tell you, some of the same statistics and megatrends which I've spoken about. I think, there's material on our website which we're obviously more than happy to delve through it in more detail.
Great. Well, we'll get into the final three questions that we like to end every interview with, and the first one is: do you have any books that you consider must read?
It's a good question. I've got 3 young kids, all under the age of 4.5, and my wife has given me a Kindle so that I can, actually read more rather than just read the sport or whatever on my phone. And,
what's wrong with sport?
So there are lots of. Despite having 3 young kids, I've actually been reading quite a lot. But if I think of one of the most formative books, actually, is one called Mindset. I don't know if you guys have heard that. It's by Carol Dweck. So it's called Mindset. She's basically a psychologist at Stanford in the US. It's probably been the most influential book on my life. And it's about highlighting the difference between having a growth mindset versus a fixed mindset. And a growth mindset essentially is about indicating that intelligence is something that could be developed and improved. It's about encouraging learning rather than thinking it's a preordained, attribute. And so it's just interesting because it encourages you, to embrace challenges. You praise effort and process, not outcomes, and you learn from mistakes. And so mistakes and failures are actually just seen as learning opportunities, nothing else. They're not seen as a sign that you can't do something. The whole book is grounded in academic studies which highlight the implications of adopting a growth mindset over a fixed mindset. That's one which I think is fascinating. It's had a big impact on, as an investor, is really important, but also the way you raise your children. A lot of her studies are about how you raise your children and about praising effort, not outcomes. So that's one which I'd highly recommend. So Mindset by Carol Dweck. And actually the CEO of Microsoft says that's the most influential book he's ever read. And it's been quite influential in his turnaround of Microsoft.
Wow.
So that's one, yeah.
Well, you're in good company there with the CEO of Microsoft. So the second question that we like to ask, forget valuation or anything today, just purely based on what the company does and fundamentals. What's the best company you've ever come across?
I have to say it is actually Microsoft. It genuinely, when you, and it seems ridiculous, I would even say that now, given the size of the company. But when we look at the growth of Microsoft, given the size of the company, it is still significant. They just printed 19% organic growth in the last year. They have very high margins, and over the next couple of years, they are going to get to 100 billion of free cash flow. And if you think, okay, that's interesting, but how much capital do they have they had? What's their manufacturing or their the technology, or what have they spent to generate 100 billion? Their capital is less than 100 billion. So the returns of every year they can generate more than their capital base. I mean, it's quite phenomenal in terms of the growth rate, and then it's also completely is effectively not bulletproof, but it's insurmountable in terms of their scale, how integrated it is into everything, the pricing power they've got. So I think Microsoft is really a fantastic business, and it's got all the kind of characteristics in terms of growth, free cash flow, returns, good management that we look for in a company.
Yeah. Well, I mean, that answer ties well with the idea of a growth mindset because, Microsoft, for all their big successes, and there's been huge ones, they've also had some notable failures, and here they are going again and, trying new things and is succeeding with a lot of them. So, yeah, love that answer. The final question that we always like to end these interviews with, Alex, if you think back to, your younger self when you were just starting out as an investor, what advice would you give your younger self?
It's a good question. So I think aside from saying have a growth mindset, which
and invest in Microsoft.
Invest in Microsoft. Yeah.
Aside from saying that, I think it's really just again, I guess it's intertwined with the earlier question. The book that got me interested in investing was Peter Lynch, One Up on Wall Street, which is a really readable book. I knew nothing about investing, and I read that, and it kind of drew me in. And really, it's just about taking in your surroundings and trying to identify opportunities, in terms of people you speak to and the things you see around you, whether it's, the Apple iPhone or everyone using a certain media platform. But, really, I guess the best advice for my younger self in terms of investing would just be to, start reading, find what you think is interesting, and just go for it. You can have dummy portfolios and you don't need to put actual money down, but there's no barrier to being able to invest and start from a young age.
Love that, Alex. Great way to finish the interview. And, we really appreciate you coming on and sharing, what is a really fascinating topic and one we haven't actually covered on the show before. So it's great to hear, how you're taking these big mega trends and turning them into investment opportunities. So thank you very much for your time. A reminder that if you would like to find out more about what Alex is doing, just head to the Fidelity website, and the ticker code for the fund is FDEM. So Alex, thank you very much. We appreciate you taking the time.
Yeah, thanks for your time.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. Equity Mates gives listeners access to information and educational content provided by a range of financial service professionals. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Equity Mates Media does not operate under an Australian Financial Services Licence and relies on the exemption available under the Corporations Act 2001 in respect of any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast or video. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.